There's been a lot of buzz lately about Donald Trump discussing the idea of introducing 50-year mortgages. And regardless of where the policy ultimately lands, I know people are already talking about it. That means as a real estate professional, it's my responsibility to help clients see the full financial impact, not just a headline. So here's the basic idea. The 50-year mortgage would stretch your home loan over 50 years instead of the more common 30 years. In theory, this would reduce your monthly payment because you have more time to pay. This is the concept that President Trump has floated as a way to help improve housing affordability. But like all ideas, it comes with a trade-off. Here are some advantages. First, lower monthly payments. Because you're spreading the debt over twice as long, your monthly payment could be smaller. Next, it could be easier for you to qualify, potentially. With a lower payment, you might fit into your budget more easily, which could help first-time buyers or those with tighter finances. And lastly, getting into the market sooner. If the alternative is renting forever, a 50-year mortgage might make home ownership more accessible earlier. So from a monthly cash flow standpoint, it can look attractive. Now, the flip side. And this is where I, as your agent and advisor, want to make sure you understand the full picture. First, a much higher total interest is paid. Because you're borrowing for 50 years, the total interest bill is significantly larger. Next, slower equity buildup. With a 50-year term, early payments are heavily interest-based, so you build very little ownership for a long time. That means you're slower to build wealth through your home. Next, potential market effects. Some experts warn that making it easier to borrow might push home prices higher if supply doesn't increase, which reduces the benefit. And lastly, risk of being in debt forever. If you're paying over 50 years, you might still be paying well into retirement, or you may not own much equity when you need to move or downsize. So in short, lower monthly payments are good, but they come with long-term costs you'll want to weigh. As your real estate agent, here's how I recommend we think about this. Don't assume it's always better. Just because the payment is lower doesn't mean the deal is better. We'll need to look at how much more you'll pay overall, how long you plan to stay in the home, and your goals for equity. Plan your term realistically. If you may only live there in the home for like 5 to 15 years, a longer term might make less sense because you won't build much equity. Keep exit strategies in mind. If you go a 50-year term, do you have a plan to refinance, pay additional principal, or move? Because that flexibility matters. Compare it against other options. Watch the details carefully. If and when 50-year loans become available, the interest rate might be higher because lenders assume more risk. So the lower monthly payment benefit might be smaller than expected. Align with your long-term financial goals. If homeownership is for you, is about wealth building, not just monthly cash flow, then slower equity could be a disadvantage. We'll need to match your mortgage term with your personal plan, retirement, future moves, kids, etc. Bottom line, the idea of a 50-year mortgage is interesting. It could help reduce monthly payments, which may make homeownership more accessible, but it's not a no-brainer. And there are trade-offs, equity buildup, and pay more over time. I'm here to walk through all of the options with you. Use real numbers and help you pick the path that meets your budget and your long-term goals. If you're thinking about buying soon or want to explore what this means for you specifically or your situation specifically, let's connect.